just play. Okay. All right, so this is going to be a presentation Mike's doing, my partner. It's really quick. It's only about 17 minutes long, and it's the actual offering, the actual what we call a slide deck. So this is the deck for the property we're doing right now. We're just getting started raising capital for, and it's 176 units in Arizona. So I'm going to go ahead and play it, and then as you guys have questions, signal me, raise your hand, something. Let me know there's a question, and I'll stop the thing. I'll stop the video, and we'll continue forward. We kind of did this last minute, and I'll do this again probably in a week or two, and have a little bit more planning behind it.
Here with Nimble Capital Group. This
Can you
is
hear
the
okay?
Reader's Digest version of the webinar that is also attached. My goal is to keep this very short so you can get a high-level overview of what this project is about. Very quick disclosure, this is not a solicitation or an investment offering. Please do your due diligence, both financially and on general disclaimers. Take a read that. All right, so what do we have here? We have executive summary. We are building a ground-up project, 176 units in the city of Casa Grande. Basically, fastest growing suburb in Greater Phoenix, one of many of the fastest growing. It's going to be 2 and 3 stories. It makes it 1, 2, and 3 bedrooms. I'll show you all those. Lots of amenities. This is a Class B product that's going to look like Class A. When we say Class B, because we're really trying to attract that middle market. There's a few more things that will happen after that.
So you guys, I don't know how familiar you are with apartments and stuff. It looks like, I just want to ask, do you know what a Class A apartment is? Do you know what a Class B apartment is? You kind of have the idea of what those might be? So a Class A apartment is one you and I all of us would want to live in. It's got the resort style pool, it's got the gym, it's got the Amazon Amazon amenities. It's in this case too, we have luxury or trash service pickup. So we'll have every day someone will be going by each and every apartment to see if there's trash by the door. So people will pay an extra amount for that to have
They leave it by
trash
the door?
picked up. They just leave it right outside their door, and we'll be there to pick it up at a certain time every single day for them, so they don't have to walk down to the trash cans.
Yeah, but what about the odor in the hall?
Yeah, there's a process and a system that'll keep it from being, yeah. There's no hallways, but yeah,
Okay.
so.
From an economic development standpoint, Casa Grande is ideally located. It's sandwiched right between Phoenix and Tucson, 2 major hubs that have really seen some really nice growth in employment and innovation. Casa Grande itself has quite a bit of opportunity as well from an economic development standpoint. Freeway close, really good opportunities for rail, transportation, airlines, population growth. So really growth in population has come about in the last couple of years. Daytime population is actually more like, permanent population is more like 66,000. So about 30,000 people drive into town, typically from South Chandler or from Tucson, and they come in and work. And that has been a huge change in what's happened in the city itself. The average median income used to be around 64,000, 65, 66,000. That is now up almost $20,000, primarily because you have some high-end engineering positions that have moved in over the last 3 years and really bumped up the average median income, which is fantastic. Average household income, excuse me. Overall, good population near our project. Some things to look at from a national level and as far as where the biggest growths are in different cities. And you can see Casa Grande has hit the market at 6.2%. Very, very good, as well as some of these other cities as well. And what's interesting in all of these 5 cities, specifically in the Phoenix area, is they are all 30 to 40 miles outside of Phoenix MSA, the Phoenix downtown area. So they are suburbs that have seen nice growth, not just because of housing, but also because of economic development. Speaking of, these are the current largest employers that are in Casa Grande today. Lucid Motors being number 1 as far as highest end positions or jobs. If you're not familiar with Lucid, please look them up. Lucid Motors, they're creating a high-end electric car. They're on the road today. They've delivered, I think, right around 3,000 vehicles thus far. And they are an early Lucid is the way we'd like to see it. Banner Health is a large hospital organization in Arizona, comparable to Kaiser of California. They are the Kaiser of Arizona, and they have a very large presence in Casa Grande, and they're looking to build additional medical office buildings across the city. They have a large full hospital there. Hexcel's in aerospace. You guys have probably heard of these other companies. I won't talk about that. this is an important piece. These are additional companies that are coming in. I'm sure all of you know Kohler, bath fixture company, building a massive distribution center in Casa Grande. And then these other 4 companies are related to the microchip industry, specifically Taiwanese semiconductor company TSMC. They're building their first North American plant in North Phoenix, so quite far away from Casa Grande, about 70 miles. However, what these companies do is they're all suppliers to this chip company, and so they're the necessary products that they need in order to make those chips, the wafers. And so these companies have actually purchased land down in Casa Grande, building their facilities as we speak in order to supply the chip company TSMC, along with Intel, which is another chip company. Of course, you've probably heard of them. They're in Chandler. They've been in Chandler. They are now adding $10 to $12 billion in fabrication facility. TSMC total project is about 30 plus billion with a B, and that's broken up over a few phases, so 13 to 14 billion per phase, and they're having 2 phases with 3 more phases to go. So really good diverse economy that didn't exist a few years ago. So that's why we're very excited about trying to be early in the marketplace before things really get out of hand.
Everybody with me still? It's all good? You understanding everything? Just wanted to check up with everybody. No questions here inside the room?
Okay. Online, you can't really hear the video. I have to hold it up to my ear.
It's not loud enough for you?
No, I can hear you great, but the video is very quiet.
Okay.
Also, he doesn't speak real clear.
He's trying to do it fast, so he's talking fast. Let me see.
Let's see if this works better. Mike checked that for me, but let's see.
Investment highlights. This is a key piece. Obviously, we have this broken up into
Is that better?
Well, it's better, but it's still really quiet. I can at least hear it and look at the screen though.
It's going to be really loud in here then, guys. Let's see.
2 tiers. Essentially, this A1 stack will sit slightly higher in the position, so this is a preferred share, common shares, a slightly higher minimum, but also a higher return. And we're doing this, again, just to incentivize our investors to come in with a slightly larger amount. You'll have a little bit better equity multiple and a higher projected IRR. Both investment share classes have the same split, 70% to you, the limited partner, 30% to us, the general partner. Our hold period is 3 to 8 years. Really, this model is based on 3.5 years of hold, which is
So the next slide, I believe the next 1 or 2 slides will explain this a little bit more. So if you don't understand or know what equity multiple is or what projected IRR might be, internal rate of return might be, the big deal, the simple way to look at it is that it's 2.2 times the money that you put in. So if someone puts in $100,000, our projection is to get not only their $100,000 back, but another $120,000 in return. That's the model as we have it now. Yeah, I think he's going to explain that in the next slide. I just want to make sure.
Build a project, start to lease it up, and exit. The reason we have a wider range is if there's something that changes in the economy that doesn't allow us to hit the valuation that we expect, then we would likely hold for longer, so we want to be very transparent with that. The projections are, again, I mentioned 30, 70, 30. The split does move to 50-50 after achieving a 30 IRR. So once we overachieve this, then the split goes 50-50. So it's on top of, if we hit a 32% IRR, then that delta gets split 50-50. On the class 2, or excuse me, A1 breakdown, this is a nice visual to see your investment of $150,000. This would be the proceeds, $195,000 in equity gain plus your 150. So those 2 numbers together, 195 plus 150 equals 345 in return. That is a 2.3x return. Very healthy, 29%. Some of you may be asking, this is impossible. How can this be true? This is hard to believe. Look, I didn't know investment opportunities like this even existed a few years ago, but real estate in general, multifamily value add is typically between 15 to 20% in a average year. Construction market, new construction products are usually between 25 and 35% IRR. So these are very, very conservative and very normal, to be honest with you. It's just most of us have not had the exposure that some of us that are in a small group of investors or just connected to someone that does this work. So you are now connected to somebody that does this work and you have the opportunity to invest. Going into common shares, A2, same thing, 120 plus your 100, 2.2x. And so that's your IRR is, again, over 3 years based on a 36-month exit. Overall, high-level returns, all I want you to look at is we are using a 4.1 exit cap. Today's cap rate, if we had a product built today and we were to sell it, you'd be selling at a 3% cap rate. So we added 100 basis points to be very conservative. Over 3 years, you would normally only add 10 to 20 basis points. We added 100 basis points. So be conservative. Again, that gives us an exit valuation of about $84 million. How are we using the funds? So this is on the left side, total sources, $56 million. This is the current GP injection, 1.6 million. We're looking to raise a little over 12 from our investors, and then we will have debt mixed into a combination of construction loan and mezz, 75% loan to cost. So it's 56 million total. That breaks down to approximately 3 million, 3.7 for land, hard costs, which will break down into several phases. Soft costs are mixed into that. And then of course, carrying costs, finance costs. This has been the biggest variable that's been changing. This number was about $25,000. Now it's gone up to about 30, so substantial, but manageable because there's been other things that have been reduced, like hard costs. These are our two partners thus far as financing. We're just dialing those things in as we speak. Breakdown of all of the hard costs, 45 million.
Are we going into too much detail, not enough detail? Are you guys understanding everything? We're good? Okay, we're good? Okay.
Can we have a, excuse me,
Go ahead.
can we have a copy of this one related to?
Yeah, I can email it to you. So if you email me requesting
Sure.
the presentation, and I can email the presentation back. It'll have this version, and it'll also have a version that's got a 50-minute version. Basically, it's the one we did live. So it's a live interaction. I'm on that call, and that one takes almost an hour. But this one here, I challenged him to say, hey, can you get this under 20 minutes? I wanted it to be fast so that everybody could, listen, and most everybody has 20 minutes in their day. They can listen to it, and then they can listen if they want, and if they're really looking to invest, you can listen to the full version. It's basically the same information, but he's really trying to speed through this as best he can so he can get it under 20 minutes.
Okay.
Million, and then 5.3 else.
So I say email me, but my email is mark@markchapel.com if you don't already know.
Okay, okay.
Soft side, again, you guys will have this deck, you'll be able to review it. Different things that we look at from an analysis standpoint to mitigate risk, and so you can see the downside on exit cap rate. If we hit a 5% rate, it's still not bad. You get 1.5x versus 2.65, but very good on this side, and this is 2.6.
So this, unless you guys have looked at stuff, you're definitely not going to understand this part. So I'm going to try to skip it if I can even a little bit, but I want to explain. So basically what we're doing is we're saying that our exit cap rate, which means is the cap rate that the buyer is going to buy this property when we exit, when we sell, is at 4.1% is our estimate right now, our projection. What he's saying here is that if cap rates continue to improve, which means investors are getting properties at lower prices, right? That means the cap rate would be up to 5% possibly, and I think we could probably even eliminate a couple of these and make it a little bit easier, but if we go from 4.10 to 5%, that would mean we would be selling the property at a much lower price, so therefore our return would be much lower, and we're talking about a 1.5 return. So if you put 100,000 in, you'd make 150 back. So you get your 100 back plus an additional 50. So you'd still make a $50,000 margin, even if things go right down the toilet and the margins get even worse than they are right now.
6.5 at the property level, so it's a little bit closer to 2.3 is what we're projecting. So we still have lots of cushion. Same thing, the clubhouse, 3-story walk-up, everyone gets a balcony, we got full amenity package, pickleball courts, dog.
So this is the artist rendering for the property. This is about what it's going to look like. We still have to go to the architect for the final workings, inner workings of the drawings that explain all the heating and air systems, electrical, all that stuff. It's like $500,000 for the final work with the architect. And I think the dollar amount is in your later slide, but this gives you an idea of our intent or the plan for the property is to look like. So I think most of us, if we're renting an apartment, would like to live in a place like this.
Dog park, pet park, kids area, pool, solar powered electric chargers, solar panels on the carports, garages will be available. So this will look like a Class A property. Again, we're just going to market it to a Class B or a more of a working class blue collar tenant base, and I'll describe that in the tenant resident base. I'll describe that in the rental rates that are coming up. This is the current site, is what it looks like. Peart goes north and south. The city of Phoenix is here, about 40 miles away. Highway 10 runs essentially parallel to Peart in this case, north and south. This part of I-10 is not east and west, it's actually north and south. Rodeo is the southern street, and the project will be brought from this street across. So this is 14 acres. We have a corner parcel that will not be part of the project, commercial, and the rest of it will be a site plan that looks just like this. So looking down from the top, this is the site plan. This is the same Peart Road, Rodeo down here. You can see we have turnout lanes. We'll have a light here at some point, and these are all the building layouts. So this is the site currently. This is probably the coolest picture we have. All of our approvals and major hurdles that typically stop projects like this. All were approved in October, and so we got full green light to build this project and approved from the city. So a very big move, and that's why we feel comfortable now to be able to raise private equity.
How far is it going to
Layout, you got 88.
Okay, hold on, real quick question,
How
yes?
far will it be from the I-10?
It's just like a half a mile. Yeah, it's pretty close. It runs parallel with that one road on the right side,
So
Peart or
that'll
whatever.
be easy.
So
on that
it's
back
pretty
side.
easy, yeah. It might be a mile away, but it's
Okay.
pretty close.
Okay.
44 units in each style of 1, 2, and 3 bedrooms. Again, this is a layout typically. We're going to do a modular pre-panelized fashion, which means pre-assembled walls, interior walls and exterior walls, and floor trusses made out of light gauge steel. That will allow us to assemble the product on site much faster, saves waste, or reduces waste, saves labor, increases productivity. Brock Danielson is our development manager. We would not be able to do this without him. His background and experience is almost 40 years in the business, some sort of real estate development construction across a multitude of different asset types. And these are some of the examples, but he's worked for Ticketmaster, obviously himself, Guardian Storage, and Bear Holdings. And so this is all his ground up development projects, from townhomes all the way from 9 units to 173 units, ground up office buildings, so large towers, tenant improvements within those towers, building actually new towers, value-added multifamily. These are just a few. Again, there's a list of almost 6,000 units, and then ground up storage. So lots of experience from our team. Speaking of team, well, none of this is possible without all these trade partners. Canyon Building Design is a general contractor. They will be our builder. We have used all these other subcontractors for some sort of engineering, site work, lending, City of Casa Grande, of course, finance I mentioned, attorneys, architects, and then also the utility companies, which are obviously critical to make sure, one, we can get services, two, we understand the cost of getting those services, and they're really all partners in the deal as far as helping us get this project built. A little bit about our team. I said my name is Mike Angelo. Michael Wagner is my partner. Mark Chappell and Amy Cooper are our other partners, primarily focused on existing multifamily value add, but we are all in Casa Grande. You can see we have 2 projects here, a redevelopment project and this ground up project. The market is ripe for redevelopment down there, and so we're really excited about being that. I'm also a passive investor, so we have investments in about 600 units across a few projects. Eric Stewart is our key sponsor. We're partnered with him on other value add deals, very focused on existing multifamily, owns about 3,000 units across the US. He's also a full-time commercial lending advisor and runs a brokerage firm. So as far as securing debt and understanding all the nuances, he will help us navigate that as we qualify for about approximately $42 million loan that we'll all be signing on. The general partners will sign on. Lastly, property management. This is the team we use to do all our market research, and they understand the nuances of what it takes to build a pro forma, look at rent possibilities, look at other income, expense ratios, and build all that good stuff out. I'll show that to you right now. Rental comps, I'm going to skip this because it's really hard to read. Here's our current rents, $1,850, $1,950, and $2,200. You will see that in the prior slide and other slides that today's rents are actually higher than this and those properties are over 20 years old. And so what we put in is we believe the pro forma that you see in red is what we actually use to build the returns out, but we're anticipating, but not factored, that at least 2 to 3% increase per year until lease up, so call it 30 months, 2.5 years. We'll see somewhere between 7.5 to possibly 10% growth, where these numbers will likely go higher, but these are renting for much more today, and this is a brand new product, which are typically considerably more than existing value add. There's the breakdown on income, approximately 4.5 million, broken out from pure rent plus other income. Expenses are averaging about $6,100 per unit per year. That is actually very healthy. It actually could be and will likely be lower than that. Existing value add, meaning 1970s, 1980s properties in Phoenix average about $5,500 to $6,000. So this is a brand new asset. So things like maintenance and repair should be virtually zero, but we still have a number in there to help us, again, create some cushion. I'm not going to go through these details here, but this is essentially talks about absorption. We're going to have the big thing to look at is increase in occupancy. And even though we have more units online, we're going to see a high level of occupancy, basically nearly 100% is what you're going to see. Same thing overall, occupancy, just looking at it slightly different for the next few years. Occupancy conclusions, this is a report done by CBRE specifically for this project. They looked at local rent comps in Casa Grande, and they're at 98%. We use 95% to be conservative. Lastly, rents, even though the market has adjusted, values have adjusted, rent really hasn't come down in Casa Grande. Even in Phoenix, we've seen slight adjustments, but Casa Grande has not seen any kind of decrease yet. And so there's still massive projections, and our numbers are actually well below that. So we believe the rent growth will be more than within our pro forma. Household growth, again, just talking about population, we see a full upside. Anything over 1% is very, very positive. And income distribution, same thing. We're targeting kind of the 50K and above. That's our tenant base that we're really looking for. And again, as I mentioned, we're really looking to build that Class B product that'll look like Class A, because that's a segment of the population that's definitely not addressed very well. Very diverse economy from a trade standpoint. Got lots of folks doing lots of different things, and that's a good thing. And just some comps from occupancy. Lastly, just some sale price on the land. Those are all good. What's next? Here's some information, 75K. This is a 506B offering at this time. That means we must have a existing relationship with you in order for you to be an investor. You don't need to be accredited. The definition of accredited investor has two components. One component is an income component, which is individual over 200K a year, and expecting to make the same next year. If you're married or filing jointly, 300,000 a year. So that's the income side. Otherwise, the other option is your net worth, not including your primary residence, must be valued at $1 million or more. So that's the definition of accredited. Right now, we can take up to 35 sophisticated investors into this deal. Then this deal will switch into a C offering, where then you must show and verify that you are an accredited investor. Funding deadline is December 14th, coming around next week. We expect paperwork to be ready very shortly in the next couple of.
So obviously we got an extension on that with Christmas and all the stuff that's been happening. We just asked the bank for an extension on the time, so we have through December now. But of course, anything that if we know someone that happens to be investing or would like to, or if you would like to, we would want to talk with you before the end of the year for sure. So I'm going to let him finish out his last 1 minute here.
4 days. It'll be in the portal. You'll get the link. Deadline is here, and then we're basically processing the transfer of deed by the 16th. Thank you so much.
Ha! He cut himself off. All right, so what sort of questions do you have here on these? Any one of these slides that caught your attention, or you weren't sure,
Meeting everybody.
or you didn't understand? What sort of issues might you have with that?
I have a question.
Okay.
How many multi-unit units are there versus homes there? Are there more homes or more?
Far more homes, residences, but there, like you said in the video, there's only been, there's no new construction apartments right now. So the newest product is 20 or 25 years old. So our competition, so to speak, was built in 2000 or older. So there's no other builds. We've been working on this, I mentioned already, for 10 months. So we have all our accommodations, all of our stuff is done. The city has given us the approval, the green light. Now we just need to raise capital, and during part of that capital raise, we'll use that money to put up the traffic signal that the
Right.
city wants us to do. We'll get all of our utilities put in. We'll get the architect. We'll get the architect drawn in. The big deal is getting the architect in, because that's the most expensive out of all of those things. Getting the architect to finish up. And that's all going to take us about 90 days. And then we'll engage the contractor during that time. And then at some point, the contractor will ultimately start working, so we're probably 6 months away before we physically break ground. But it'll take about 2 years to build once we're ready to go. So we have about a 2.5-year window from now that will actually be ready to go. The intent will be too, when you look at the buildings and the structure, there's 2 buildings that kind of look like they're apart from the others. Our intent at the moment is to build those out as quickly as possible and start leasing them while we're still working on the rest of the project. So we're kind of hoping that, in 2 years from now, we'll have product that's leasable, and then as the property continues to build out, we'll start leasing up, as we build. So we can start generating some income from it. Right now, again, if you invest $100,000, if you want to play safe and just say it's a two times equity multiple, it's called. So that equity multiple, you put in $100,000, and for about 4 years later, you should get $200,000 back.
Okay, and it's not saturated there with multi-family units like
No,
this in the valley?
that's exactly why we need it. There's
Okay.
not been one built in 20 years. And with all the new growth in that market, the big one was Lucid. They hit Lucid about 3 years ago, and Lucid Motors came in, and they brought a lot of jobs.
Right.
And then now Taiwanese Semiconductor, about an hour away. All of those 5 or 6 companies have already bought land and are already building property. That's all jobs that are going to be needing to have somewhere to live. And then the last part of that is that their incomes are all going up, so they can afford, the higher end rents and
Right.
to live in a nice place.
Plus all the people are migrating out of, crazy.
Well, out of Phoenix, Phoenix got too expensive, so that's why all these companies that bought the land in Casa Grande, they could have bought land in Phoenix,
Yeah, but it
but
wouldn't
chose
be
not to
profitable.
because it's just too expensive.
Yeah, it wouldn't be as profitable.
Yeah, you saw the population growth in that ring in that one slide.
Right.
And that population growth, all those 4 or 5 cities, those 5 cities that are in the Phoenix area are all suburbs of Phoenix. Those top 5 growing cities.
Right.
This slide right here, this whole area here is those 5 cities that were in the top 5 fastest growing cities
Wow.
are all in this ring, and that includes, of course, Casa Grande. So you see the population, the big deal you mentioned, you're asking me about, what is population doing? Is there a need for housing?
Right,
And-
well, in
and,
other words, because in the valley, it's so oversaturated
Right.
with apartments
Right.
that,
Well, and
Yeah.
our valley or the San Fernando?
No,
Valley?
San Fernando
So,
Valley.
but yet they still get $3,000 a
Oh,
month
yeah.
for a 2-bedroom.
Oh, yeah.
two-bedroom,
Oh, no,
right?
more than that.
So saturated, so it's
Yeah.
clearly not too saturated because there's plenty of room.
no, but
for
I was
growth.
just wondering what the growth was.
Right, so
here.
this is the population number there right now during the day, which means that there's about 30,000 people that come in
Right,
daily,
Daily.
commute to this area for work.
yeah.
And they don't have, obviously, you would think that if there was housing available, they would live here. So Julie, Sarah, do you guys have questions?
Question.
Anything, Monique, any questions? I know there's something you guys had to think of.
Let me ask you a
All right,
question.
so go ahead.
Besides this raising capital, do you go through a construction loan to finish the product?
Well, yeah, for sure. You have to have a construction loan, yeah.
This is a part of that project.
Yeah, if you look, there's a slide there that breaks all that down.
It's all
but-
inclusive, right?
But what we're doing ultimately is our raise, the total raise is gonna be about 13 million. The rest of it is all financed,
Okay.
right? So we'll have a construction loan, and then we'll go into the perm, they'll always call it perm, but it's permanent financing, and that'll be at a different time, and that'll be at a later date once the construction is done.
Okay, those people which is put money, after 8 years, 3 to 8 years, must we go out, exit the project, or can it stay?
So what he's asking is, can we, whoever's got money in the deal, can we stay in the deal, or do we have to exit the property, right? That's what you're asking. So the answer is yes, on both. So what our intent right now is to either A, sell it, and we might sell it ultimately, if we can get the price that we want, if we can give you the money back that you want. Our goal is to refinance it, give you back some of your money, and keep it as a rental. And if rents are up and higher than what we're anticipating here, the value will be higher and the rents will be higher and the income will be higher. So we might, if you put 100,000 in, we might be able to give you $50,000 of your money back and still return based on the 100 that you had in originally. So your cap rates or your capitalization rates, your returns, your internal rate of return, all those things will be as though your original money. And on that refinance, that's not a taxable event, right? So you would have no taxes on that. So it's just a refi like any other refi. We'd refinance into a better loan, permanent financing, and pay off the investors if we can. That's the goal. We don't know, of course, that's planned. It's hard to look 3 years in advance. We're trying, and it looks like everything's good. We're estimating that rents are not going to go up in the pro forma. They could even possibly go down. But right now, the rents that we're starting at are the rents that are 25-year-old apartments. If we were on the market today, we would start at a couple $100, maybe $150 more a month anyway, because we're new.
Right.
But we're not using that number, we're using the current numbers based on the older property. Trying to be more conservative so that we don't just go out and project a bunch of high numbers just to get investors to come in, and then
Right.
ultimately later on we'll end up showing a lower number.
So you're
That's
trying to be
not
more
fun.
realistic.
Yeah.
Okay, in the case of selling it, what kind of multiplier, how you calculate the value at that time?
It's all based on cap rate. So again, if you look at the longer video, or even this video, that one sheet that has all the calculations on, we're calculating a 4.2 exit on the cap rate.
4.2. Yeah.
So we could go to a 5% cap rate, again, like I explained earlier, if we're at a 5% cap rate for the investors that would buy it, a higher rate, so they get more return for them, that means lower for us, right? We would still make about 50% on what we invested. Right, so Julie, Sarah, do you guys have questions? No, everybody's good? I'm seeing head nods, so a good thumbs up. So, all right, so if you guys have any questions at all that you think of later, or you're uncomfortable with something, like, I really need to know the questions, because that way, we have to understand. No one's gonna write $1,000 or $100,000 if they don't understand what's
Right.
happening. So this is what I'm doing. My goal ultimately will be to do this full-time. Right now, we just did a 40 unit this exact same way, except for it's not a new build, but it's a syndication. We closed that about 4 months ago, and that was on that property list that you saw earlier in the video. So he's my partner on this 40 unit as well. And then I'm in passively, like we're talking about for you guys. I've invested passively with this company in Texas and in New Mexico. And then we've got some other passive investments as well in Texas and in Florida. So if you want to talk just general syndication, we can have that conversation. Or if you want to talk about this deal specifically, or you want this slideshow that we just did, the long one and the short one, just email me, mark@markchappell.com, and I will email it to you.
Okay, great.
Okay. All right, guys, thanks for being here.
Thank you.
Have a good rest of your day.
Thank
Have a
you.
good Christmas.
All right, so before saying, I see all the notes here about some clients, so we need to make sure that everybody is good. So I'm going to take a quick picture of that. I think Mike has it all recorded anyway, but. I got to really bring my glasses in when we come in and do these so I can read that.
Yeah, minor detail, right?
Can't read it.
2 things you can't forget, your phone and your glasses.
Phone and glasses, yeah.
You ready for Christmas?
Almost.
Me too.
Yeah, getting there. I don't do a lot.
How are you?
To be fair, I don't do a lot for Christmas, so
You do or don't?
don't.
This year I'm not doing a lot. Didn't have the time. You ready for Christmas?
Merry Christmas. Bye-bye.
Thank you. All right, see you guys.
Christmas?
Great, but not too much.
This is the first year.
See if Zoom is still up.
Oh my God. I cannot see from here.
What'd you click on?
Oh, just
I didn't see
down
that. I didn't see
there,
that pop up. Where'd you click?
down here, it says end
Down
session.
here, I don't see anything here.
So once you join the meeting,
Right?
it'll pop there,
Right.
and then the mouse.
I still didn't see anything that said exit. You clicked something and the exit popped
Yeah,
up.
and
What'd you
then-
click though? End session. Where was it? I looked at the whole screen.
It was down there.
All done?
Yeah.
I am. Nice. We'll go through it again later, but